All right, let's jump right in. Today, we're breaking down the second quarter earnings call from MidCap Financial, ticker MFIC. Now, on the surface, the numbers were a little all over the place, a beat on one thing, a miss on another. But the market, well, the market loved it. The stock took off, and we're going to figure out exactly why. And I mean, it really took off. The day they reported, the stock popped almost 3.5% and on way higher trading volume than usual. That's the kind of move that gets your attention and tells you there's a real story hiding under the surface. So that's the big puzzle we need to solve, right? Usually when you see a company miss on revenue and its book value goes down, you don't expect the stock to rally. But that's exactly what happened. The market was clearly looking past the headlines and saw something much, much bigger. Let's dig in and find out what that was. Okay, first things first. Let's lay out the headline numbers so we're all on the same page. And right here, you can see that mixed picture I was talking about. Their net investment income, or NII, which for a lender like MFIC is kind of the key number for poor profits, came in really strong at 39 cents a share, a solid beat. But at the same time, revenue came in just a hair light, and more importantly, their net asset value dipped by 1.2%. So you've got this weird combo of good and bad news that could have easily pushed the stock down. So, what did management have to say about that drop in value? Well, the CEO, Tanner Paul, was really direct about it. He basically said, look, this isn't a portfolio-wide problem. He pinned the blame on just a few specific companies that are having their own unique issues. Now, that context is absolutely crucial because it told investors that the main loan book, the core of the business, is still in great shape. Okay, so calming fears about the NAV was important, for sure. But that's not what lit a fire under the stock. No. The real story, the thing that got everyone excited, was a massive catalyst that the market sniffed out right away, the big strategic move with their Merx Aviation business. So what in the world is the Merx unwind? Well, think of it this way. For a long time, MFIC has owned this aircraft leasing business, Merx, that doesn't really fit with their main gig, which is direct lending. It's a legacy asset, and frankly, it just wasn't making them enough money. This whole unwind is about selling off that non-core piece and plowing that cash back into what they do best, making higher interest loans to solid middle-market companies. And the beauty of this move is how clear and simple the playbook is. Step 1, they sold off most of the aircraft. Done. Step 2, they're about to get a big check around $90 million net. Step 3, they're going to take that money and immediately put it to work in their core lending business. And what's the result? Step 4, a direct, meaningful boost to their net investment income. It's a clean, straight line from a smart sale to higher earnings. And just look at what this does to the company's overall profile. This one deal cuts their exposure to this legacy Merx business in half. It drops from over 5.5% of the portfolio all the way down to just 2.8%. This is more than just a financial shuffle. It's a huge step in de-risking the company and making their story much cleaner and easier for investors to understand. And here it is, the magic number. This is what the market grabbed onto. Management came right out and said it. Redeploying this cash is expected to add an extra 6 cents per share to their annual earnings. That is a tangible, easy-to-calculate boost, and that, my friends, was the answer to our puzzle. Now, besides that huge Merx news, management also gave us their read on what's coming down the pike, talking about both the challenges they're facing and the opportunities they see. And they were pretty straight up about it, which is what you want to see. On the headwind side, they said, yeah, it's a competitive market out there, so the interest rates they can charge on new loans are tight. They also warned about a potential creep in non-accruals. That's just loans that stop paying interest. But then you have the tailwinds. They expect M&A activity to pick up, which means more companies will need loans, and they see a chance to refinance some of their own debt at a lower cost, which would boost their profit margins. They also made it super clear that they're sticking to their guns on discipline. They're keeping leverage in check, right around 1.4 times, and that's before the Merx cash comes in and lowers it even more. They're not getting sloppy with their lending either. New deals are still being done at a conservative 4 times leverage. Plus, they're using their power of incumbency, which is a fancy way of saying more than half of their new loans are going to companies they already know and trust. And to top it all off, their credit rating was just confirmed at BBB- with a positive outlook. That's a huge green light for their access to capital. So you take all that analysis, the strong earnings, the Merx catalyst, the disciplined outlook, and what do you do with it? How do you turn this into an actual strategy? Let's talk through a couple of trade ideas. Yeah, how would an analyst play this? Because when you put all the pieces together, a few pretty clear paths start to emerge for how you could position yourself for what's coming next. Okay, so here's our first idea. Let's call it the Merx to alpha conversion. The whole thesis is simple. We believe the market still hasn't fully baked that extra 6 cents of earnings into the stock price. So the action is a tactical long position. You could buy the stock, or for a little more juice, maybe look at some call options 6 months out. The goal is to ride the wave as the stock re-rates higher once that new, improved earnings power starts showing up in the next couple of quarters.
Now, trade idea number 2 is a bit more sophisticated. We're calling it the leverage to value arbitrage. Here, the thesis is that MFIC's boring, disciplined approach to lending is actually going to be a huge advantage, especially if the economy gets a little rocky. So, the action here is a pair trade. You go long MFIC, but at the same time, you short one of their competitors that's been taking on way more risk. The goal is to profit from MFIC outperforming its riskier peers, especially if credit quality starts to matter again.
So to wrap it all up, this quarter from MFIC was way, way stronger than just looking at the headline numbers would suggest. You have a solid beat on core earnings combined with this super clear catalyst that's going to drive growth. This sets MFIC up beautifully as a quality carry story that also has a very specific, very visible catalyst for upside. For those reasons, we're initiating with an outperform rating. And of course, we always have to say this. Remember that this is just our analysis based on public information. It is not financial advice. You should always, always do your own homework before making any investment decisions.